The United States possesses a unique ability to print and spend money unlike other nations. French President Charles de Gaulle famously described this as an exorbitant privilege. The U.S. runs massive deficits year after year, yet the dollar remains stable. To understand why, we have to look past the politics and into the mechanical plumbing of the global economy. Imagine you're the treasurer of a small nation. Your job is simple but incredibly stressful. You have to pay billions in government salaries and contractor fees on exactly the same day at the end of every month. Simply stacking physical cash in a vault until payday is not an option. Every day those billions sit idle, inflation silently eats away at their value. To avoid those losses, you have to put that money to work. You need to hold extremely safe, interest-bearing government debt that earns a return right up until the moment you need the cash. Safely storing billions of dollars is more than an accounting chore. It is a survival mechanism. And the raw math of massive transactions forces almost every country into the exact same financial corner. As that treasurer, if you buy your own country's government bonds, you face a mechanical disaster on payday. To get the actual cash for salaries, you have to sell a massive chunk of those bonds all at once. Dropping a massive sell order into a small national market overwhelms buyers and crashes bond prices, leaving you without payroll. To avoid this, you need a market so deep a billion-dollar sale doesn't cause a ripple, a financial combination known as liquidity and market depth. Because every nation needs this specific depth to survive payday, they all move their wealth out of their own small markets and into the single biggest debt market on Earth. This creates a self-reinforcing loop. As more institutions buy in, the market's trading volume grows, which provides the very stability that attracts even more foreign governments to the market. The ultimate beneficiary of this cycle is the United States and its dollar. The global reliance on the dollar is a mathematical reality for any institution needing to securely hold large amounts of wealth. Government bonds are effectively promises of future payment. While they offer daily stability, large-scale financial markets risk becoming speculative bubbles if they are not anchored to a physical commodity. Prior to 1973, international trade was fragmented. The largest international markets relied on agricultural staples like wheat and corn, but no single commodity was dominant enough to anchor the global monetary system. The 1973 oil crisis changed the scale of global trade. In just 6 months, the price of oil skyrocketed from around $2.90 a barrel to nearly $12, an increase of 400%. At these new prices, the oil market became the single largest international commodity market on the planet. Recognizing the opportunity to secure the dollar, U.S. Secretary of State Henry Kissinger flew to Saudi Arabia to meet with the monarchy. He struck a deal with King Faisal. The Arab Gulf states would sell their massive reserves of oil and gas exclusively in U.S. dollars. By linking the dollar to the world's most vital resource, the U.S. established a physical requirement for its currency, providing a foundation for its global debt machine. Because every modern nation requires oil to function, every single nation is compelled to constantly acquire U.S. dollars. Once those countries hold massive stockpiles of dollars, they inevitably park that wealth back into the deepest, safest asset available, U.S. government bonds. This network creates a massive load-bearing capacity for national debt. It allows the U.S. to borrow practically endless amounts of money at essentially zero real interest. This system functions as a financial gravity well. It forces the rest of the world to fund U.S. spending, allowing America to outspend any geopolitical rival indefinitely.